let me use a specific example of something that at least seems to me to have changed in the last 15 years, let's say. It used to be general advice to invest and to hold. And the more you could invest and hold, what's it called, buy and hold? Mm-hmm. Buy and hold, and that was the way that you kept just feeding some money into that very, whatever investment tool that you had selected, that in fact that's a payoff. Seems like that's not the case anymore. What's happened, and how did you as a group, how did you guys start to figure this out, that this no longer was an active way to do it, Dick?
You know, I don't know if there's any single rule that you have to hold to forever. Things are always changing. What used to be rules 5 years ago or 10 years ago may not be rules today. I've said for a long period of time that the key to what we do is not invest in any one single thing. We invest in a whole lot of different things that have different kinds of looks to them, and they perform different. And there's some stability and liquidity features, and there's some growth features, and there's some income features, and it's the mix of things. So I don't know how far away we need to be from this old concept of buy and hold forever. I'm not sure it's ever been right, Alan. I think old-time economists and financial advisors used to make that assumption. But I think if you take the 10-year history of the stock market, the last 10 years, it's been lousy. So if you go back for 40 years, comparing stocks and bonds, most people don't know bonds actually have done better over 40 years. And so I'm not sure that old bromide was ever true.
Is that the secret? That people are looking for bromides, they're looking for rules. It's like what horse to put your money on.
Yeah.
You think that there's that nature of the people to find out what's the formula, and in fact there isn't one. The formula is that what you're saying? The formula is moving back and forth.
You know, I think, you know, there's a whole study in the financial world called behavioral finance, and it really boils down to people are driven by fear and greed. And so everybody is trying to, you know, and that is why, you know, there's been study after study done about people doing the exact wrong thing. They buy high, they sell low, and they don't make money. So what Dick is talking about, the last 10 years obviously was horrible markets, but even before that, from 1982 to 2000 or 99, there was a raging bull market. And I bet you a lot of people still didn't make money because they bought high, they sold low, and they get in and out. And I think that's one thing that we've identified recently that we do right, and that is lower the volatility of the investments.
Yeah.
There's no major seesaws going on. And by just kind of staying straight and narrow, people stay the course.
Let's take that, the lowering the volatility of the investment. Let's talk about that more.
See, people get scared, Alan, and justifiably so. You know, they've been talked into holding a high percentage of their money in common stocks, as an example. And common stocks are going to be the most volatile of the investment groups or the asset classes. And people wind up holding a lot, and they see their holdings go down, 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 down. They read the newspaper the next day. They listen to their advisor. Oh, it'll come back, but then it doesn't come back. It goes lower and lower, and they get very fretful. They worry about it. It's their money, and they don't know where truth is. And so finally they wind up selling at the wrong time. Maybe it even goes lower after they sell, and they look at themselves and say, boy, I'm a lot smarter than anybody else. Not that that's a good long-term answer, but it's the volatility that makes people so nervous. And it's, Mark was alluding to two studies that I think are just really interesting if you really think about it. There was one study, that one he's talking about, and it's very right on, where they looked at the bull stock market. It was up for 18 years or so, and a research group out of Boston, I believe, Dalbar Group, studied how investors entered that market. What was the actual experience of a person putting money in over that 18-year period of time? And the stock market averaged something like plus 16% a year, and I might be off on my statistic, but plus 16% average rate of return per year. Well, that's great. But the average investor, Dalbar found, only earned 2%, which meant that the investor was always coming in at the wrong time and out at the wrong time. And the even more puzzling figure was in this last 10 years, the top performing mutual fund in the entire country was this CGM Focus Fund. And,
what was that again?
A CGM Focus Fund. It's a fund nobody had ever even heard of before, and that's fine. But the point is that somebody would say to themselves likely, geez, that fund earned an astonishing rate of return over a 10-year period of time, fabulous rate of return. And then if you look inside the fund itself, you say, well, when did actually people enter the investment? Completely different story. The fund earned something like 11 or 12% annual rate of return, whereas the average investor that actually participated in lost 7 or 8%. They lost money in the best performing investment that there was. So see, the problem is you can read these statistics, and I think a person said it best, these markets move based on myths and lies, and I don't want to have that misconstrued other than to suggest to people that you have to be pretty unemotional with regard to your investment decision making, number one. Number two, you've got to have a pretty good idea where truth is, macro truth is, and you've got to have your investments in a position where you don't have this extreme volatility that just scares everybody to death.
What's macro truth mean?
Macro truth means where you think the economy is going over the next 2 or 3 or 4 years, or macro truth kind of involves seeing where growth might be over a longer period of time, not just today or next week, or is this company going broke today or next week?
That would be the micro
Yeah,
part of it.
yeah.
So, John, how do you see this?
Well, I just wanted to comment on the behavioral aspect of this. You know, we were talking about volatility, and one of the things that we say again and again here is that volatility basically is peaks and valleys and chasing after the highs and swimming through the lows and things like this, and that's something that we, our system helps to avoid. The problem then becomes for the investor that doesn't understand the impact of buying and selling at the wrong time and what the volatility has on their investments and overall their portfolio over time is very psychological in nature, because inherently an investor can have an up year, just like the behavioral studies would often say that it's a lot more impactful when you lose as opposed to when you win. So what do we do here? We do our best to minimize losses. How does that impact the portfolio? It has to be measured over time, typically, because one of the things we're talking about, and I'll go back to buy and hold, the buy and hold strategy, and I'm gonna take it away from the investment community, and I'm gonna put it on something we all know too well, which is the real estate market. The real estate market, something we're all very familiar with here in Southern California, used to be of a buy and hold mentality. And for the longest period of time, it was a pretty stable and secure and an alternative asset to some of the other things that we advise on here. The buy and hold worked for a very long period of time. Then over the last few years, as people began to start to manipulate the system, fear and greed, we saw some different things happen to a buy and hold mentality.
It became buy and slip through your fingers.
It did. It became a very short-term instant gratification type of thing, the same thing that fear and greed creates in the investment markets. Prices on homes don't necessarily go up and down at the same ferocity that stocks might. Well, we might beg to differ here in Southern California, but nonetheless, what I'm saying is that the whole buy and hold mentality spreads across asset classes. It really does, and it's useful. In fact, it's useful if you're looking at it in the context of a period of time.